My name is Roxy Guane. I'm the VP of Platform Operations for iFindTaxPro. Then our second speaker, last but not least, Dmitriy Kustov, CPA, MS Tax, who's also a friend of iFindTaxPro. He's a certified compliance professional, nearly 30 years in public accounting. He's the founder of Kustov and Associates, which advise businesses in the US and internationally. He's an AICPA tax committee member, helping to shape tax policy compliance standards. He's an author. He has a brilliant startup tax guide, which is a must read, and you can catch that on Amazon. He's a speaker, published tax expert, and trusted advisor in the industry. Check out his website and LinkedIn for more information. So, Dmitry, welcome. Floor is yours, my friend. Let's look at the tax vantage point of equity versus
that's
debt.
right. That's right. Yeah. Okay, awesome. Thank you. Yeah, and as we're saying, it's the debt involves a creditor legally entitled to repayment of principal and interest, regardless of company profitability. So it definitely there is this one. Okay, so the debt versus equity question, arose pretty much more than 80 years ago, and it's a well-known issue, which is in some way a cornerstone of the U.S. taxation, because it's important for U.S. tax purposes what instrument is classified as. Equity, as opposed to debt, of course, it means when the holder is effectively an owner whose return depends entirely on the success and profitability of business. And again, the name of the instrument doesn't control at all. It helps a little. It's one of the factors, but it doesn't control. That's what's important to remember. So can we go to the next slide now? Now, why does it matter? If we say it's an important question for taxation, but why? And here are two big reasons. If it's a loan, then the interest payments that are made on the loan are tax deductible. And if it's an equity, then these coupon or little payments, they will be called dividends, and dividends are not tax deductible. So, not being tax deductible means that, let's say, a corporation has to pay tax on it, and also the individual who receiving these payments also has to pay tax on it. So there is this double taxation issue. So to avoid this double taxation issue, usually companies and beneficiaries they prefer the interest treatment. Okay, so with some exceptions, of course, interest is taxed at a higher rate as dividends. Sometimes for that reason, actually, dividends might be preferred in some cases. So it gets a little complicated, but that's where it comes in. And another point here, when investing in startups, especially pre-revenue, even if an instrument is called a loan or some other type of instrument that we will look at, it will be the last slide. We're going to go over popular types of instruments for startups. It could be, at the end of the day, considered equity, and that could actually help the investor, because there are some important preferential tax treatments for investments in early stage entities, corporations mostly. So okay, let's go to next slide. So here are a couple of examples of two more cases. In Kraft Foods, it's an older case, 1956. They had an interesting situation that went through several courts, where a subsidiary owed to parent money, and the question was it real investment by the parent in equity of the subsidiary, or was it a loan? And few courts look at it, and finally the last court said that yes, it's going to be treated as a loan. So, which means that the relationship between the parties is not always controlling. You could obviously say, well, they just gave the money because they wanted to invest in an entity, but after taking various facts into consideration, the courts finally decided that no, it's okay, it's okay, legitimate loan. Now, relatively recent court case, 2012, as you can appreciate, because it's only 13 years ago, and some of the cases we're looking at 40, 50, and this is only 13. And there, the case and situation is extremely complicated. It involves international tax planning, agreement with Netherlands about preferential tax treatment. There was a lot going on that. And what was interesting, the instrument that in question, it was hybrid loan and equity. So from the point of view of one country, it was considered equity. And from the point of another country, it was considered a loan. So I think for US, they were trying to treat it as a debt. At the end of the day, they were rejected. It was considered equity, and important factors again. There were there were a few factors, and some of them the enforceability of it. So when a party couldn't pay, the other party didn't really enforce it. They instead accepted more debt from that party. So, and at that point, court looked at it and said, no, but it looks like it's just an equity, and they simply increasing their stake in the venture. So those are examples that important. Okay, so let's go to the next slide. And so, in very general way, an overall approach may be summarized as follows: uniqueness. So each financial arrangement is unique. So that's important to remember. There is no clear cut. We will look in the next slides that they're trying to come up with precise rules, but in fact, it's not possible clearly, because there are so many possible arrangements that are available. And when there are large dollar amount, just like what John was saying, you need an audit when you have a large dollar amount. By the same token, when we're talking about bigger business, so IRS looks at it more carefully, and it very often makes its way to courts. And that's what we have, this amazing opportunity to see what the logic behind these classifications is. So that's and so the courts analyze the totality of economic substance. So they look at all the details, and none of them is controlling necessarily. Of course, related party transactions, such as parents' subsidiary, are typically scrutinized more. Okay, so that's what the approach is. Now, if we can go to the next slide. So the Congress, it attempted to codify the rules, but essentially it failed. It was in 1969. They issued this code. They promulgated the law, Code Section 385, and they basically said IRS has the authority to to distinguish between stock and debt. They just gave it to the IRS. And guess what? A few years later, IRS came back with their ruling, a regulation that is, and they basically say that determination should be under the common law principles in accordance with the factors prescribed by it. So that's basically saying that the court's precedents will sort of decide. And again, going back to the same idea that we just have to look at every single arrangement. I find it fascinating. That else was asked, okay, guys, you can tell us what you want to do. And they just say, well, we don't know because it's too complicated. So it's an interesting question. Let's go to the next slide, Rex. Thank you so much. Okay, so here, even though the Congress told the IRS, you guys go ahead and figure out what the law is, they did suggest specific factors that are relevant. And here they are. So what's very relevant when you sign an agreement and you want to treat it as a law, what's relevant here, number one, in all the circumstances, is there a certain sum of money that needs to be paid by a fixed date with interest? Super important. And whether such promise is actually enforced by the note holders matters as well. So let's say if the note holder doesn't try to collect the note when it comes due, then it looks more like it was an equity, right, rather than that. So that's it's not only how a document is created, but also what kind of actions the note holders undertake. Okay. Then a priority of subordination. So if you subordinate your debt to other lenders, that means you're putting yourself in the position of other owners. You're putting yourself very close to the position of other, in like the equity holders. So therefore, it seems to be a little more closer to equity. Then ratio, how thinly entities capitalized. What is the ratio between your equity that you have in the company and the debt? And of course, here, we sort of need to also maybe ask advice from John and professionals like himself to see by industry what sort of ratio of debt to equity is appropriate for this or that industry, because that's all looked at those individual industry levels, not all one size fits all, definitely not. Then another important factor, whether the instrument is convertible into corporate stock. So it's very relevant in the context of startups with the convertible notes, obviously. If there's convertible notes are always a suspect of being an equity. So, if you want to make them otherwise, you have to follow the steps, including enforcing collection of convertible notes. Last but not the least, the relationship between the holder stock ownership and their holding of interest in question. Right. So again, if it's a related party, like John was saying, right? If it's a mom, pop, or brother, sister, so as well as if there's a direct ownership. Not necessarily, as we saw in one of the cases in Kraft, but possibly it takes a little more scrutiny of their relationship. Okay, so those are important factors. Can we go to the next slide? But there is one important thing that this code section gave us, and it gave us a way to reconcile between the lender and the borrower. The issuer or the borrower, their original classification of the instrument is generally binding. So in other words, if a company borrows money and they issue what we have usually 1099 interest every year or 1099 OID every year to the lender. Well, they made their choice. They simply announced that we're treating it as a debt. And unless the lender has a very strong case and very strong other ideas, they pretty much going to be bound on how the borrower treats it. So maybe because of this potential controversy between lender and the borrower, perhaps some of the arrangements that call themselves loans, maybe they should be written up in advance, an agreement that we're going to treat it as an equity or we're going to treat it as a loan, so that parties are not inside a controversy of what to do with that. Okay, let's go to the next slide. Despite the fact that IRS did not issue regulations, it did issue notice. And the notice is something that is usually done before regulation is issued. So they sort of looked at it again and they say, okay, we understand what the Congress wants us to do. Here's some important red flags and couple more additional points that we think are important. Let us put it in the notice. And this is what they say. If instrument is repayable in stock, or if instrument is with an extremely long or indefinite maturity, well, those are two red flags for the IRS. And this notice is still out there, so this is valid notice. And of course, there are other things. Some of them repeat what we just looked at, which is unconditional promise to pay, fixed proximate maturity date. So we cannot say it's going to be 15 years from now. So it has to be within 3-5 years, maybe 6. Right to enforce the payment, subordination of rights to general creditors, just also talked about it, right to participate in the management of the issuer. So if you give a convertible note and sit on the board of a company, maybe it looks a little bit closer to equity, perhaps. Thin capitalization, just discussed it. Identity between holder of instruments and stockholders or of the issuers, either they're related or the same parties. The label, of course, label is always important, but it's not controlling. And another one, treatment of instrument for non-tax purposes. How do you report it on the how do you report it to lenders? Do you tell lenders that this is just my equity investors, or you tell them, well, no, I have other lenders, and you're going to be one of them. So that's all very, very important. Let's go to the next slide. Let's go to the next slide. Okay, and finally, I thought it would be amazing to quickly go over specific instruments, some specific instruments that are popular when raising money outside of actual stock purchase. So SAFE, I think, very popular, simple agreement for future equity. It has no interest, has no maturity, and usually considered equity. Convertible note, so that can have a range. It usually includes interest and maturity date, but depending on who is lending whom and whether or not they're in forced collection and whether or not it's secured, it can go both ways. It can go like a loan or equity. Keys, keep it simple equity. It's a hybrid loan equity instrument. Usually they have two types. They have purely equity and they have purely loan. But you can attempt to make it loan, but as I said, the terms are not enough. So behavior and who the parties are important. Then payment and kind notes. So that's when the interest payment, it capitalizes in principal amount basically. So you don't pay, you maybe increase your conversion later into equity, perhaps, or maybe later you get more money. So it's risk. In my opinion, it's risky of being treated as equity in one of the cases, for this Pepsi case that we had, they had this arrangement that they called baby bonds when payment couldn't be made in cash. They simply said, okay, we'll just take an extra loan. So that wasn't considered the proper loan, debt. RBF, revenue-based financing notes. It's a portion of revenues goes to investors until required multiples are repaid. This, I would say, neither debt nor equity. It's entirely different type of arrangement. We can maybe get into it for some other time. I'll just have it a little suspenseful, but I don't think it could qualify as either loan or equity properly. And finally, perpetual bonds. Apparently, there is such thing as perpetual bonds when the interest is paid indefinitely. And to me, it looks more like equity. But, John, have you ever seen such arrangements? Have you ever seen in your practice perpetual bond?
No, not outside, not within the banks and lenders. Like
Yeah.
I've seen people do friends and family perpetual bonds where here's a bunch of money and just pay me $1,000 a month for indefinitely.
Yeah. Okay. See, I think if someone is going to look at this arrangement, I think they might say, okay, maybe after 5 years it becomes equity. If you're not going to take it back, perhaps. And that was it. And that was my part, guys.
And another question, Dmitry, because I think when lending money, many of us don't think about the tax implications, right? And generally, what's more efficient from a tax planning perspective in terms of instruments?
Most efficient? It depends. You see, it depends. If you're talking to an investor, usually investors would be much happier if their investment considered all equity. But equity is not always available in early rounds. So they have to make things up and say, okay, this convertible note. And of course, they would also like to have some interest while it's being equity. So that's their interest. From the company point of view, they normally would like to get a tax deduction. And that would be more coherent with a loan treatment, okay, on the interest payment, tax deduction, that is. So there isn't, it's a little, that's why this 385C, that's why they have the specific rule. They give more weight to the treatment of the borrower. They say, okay, you're the borrower, you're going to carry this, you get to decide first. And then the lender is say, okay, if you really have strong argument, you can write to us and explain it. So it's one of the requirements. You have to write to the IRS and say, okay, they think it's a loan, I don't think it's a loan, here's why. And that's how things can be done. And in practice, we have done a few things that were of similar nature when we took positions that are contrary to what the instrument says. But again, under certain circumstances, it was justified, as I think. And, it was approved by the IRS, so that was good.
Fantastic. I think that was very enriching, Dmitry. And we just want to also get some clarity on just how people can contact you, what they can contact you for, what you can walk them through, because we really want to make that that available for our listeners.
Yeah, absolutely. Very happy to talk to anyone who would like to have more guidance about loans, equity, or anything else that has to do with tax and accounting. We're a full service CPA firm. We do everything from bookkeeping, tax return preparation, dealing with the IRS on various issues, attest services, compilations, reviews, audits. We were specializing, of course, in small to medium-sized businesses. United States international, we do a lot of international work. structuring as well as compliance work, complicated compliance. International from the U.S. point of view, we don't file any other country's taxes, just from the U.S. Inbound people that would like to do business in the United States, as well as U.S. people that go into business in other countries. So we have, I have almost 30 years experience. This company has been, I think, for 22 years. I have this firm, and so happy to help anyone who would like to.
I just want to encourage everybody to follow us on iFindTaxPro. We're at iFindTaxPro on all the major platforms. Please comment, like, and subscribe to this episode.